Quick ask. Subscribe now, then let's jump in with the numbers. Washington was supposed to be perma-hot. Tech paychecks, mountain views, and homes that vanished in a weekend. But 2025 is bending that story. Pendings are slipping, open houses feel quieter, and price cuts are creeping past Seattle into suburbs and smaller metros that once felt bulletproof. Is your city next? If your plan depends on last year's rules, you could be negotiating with yesterday. Tonight, we're pressure testing the narrative. We'll pinpoint the Washington cities where sales are drying up, where days on market stretch, inventory stacks, and sellers offer the concessions they swore they'd never touch. I'll show you how to read the signals before they hit the headlines and where patience turns into leverage. Some names will be obvious, others will surprise you, and the number one city on this list isn't the one most people expect. If you want to protect your equity or time and entry without stepping on a landmine, stay with me. We're about to map the edge together. To understand 2025, rewind the boom. Remote workers fled pricey coasts for views and space. Tech kept hiring, investors chased yield, and rock-bottom rates made monthly payments feel light. Pendings popped, bidding wars normalized, and even fixer-uppers vanished in days. Then the turn. Mortgage costs rose, and borrowed dollars got heavier. HOA dues crept to fund reserves, insurance repriced roofs and wildfire risk, and property taxes reset off higher assessments. Hiring slowed in tech and logistics, while return to office nudged buyers closer to job cores and pushed others to wait. The result isn't panic, it's a pause. Across Puget Sound and down the I-5 corridor, affordability ceilings are hitting heads. Buyers test the monthly, principal, interest, taxes, insurance, fees, and discover the leftover doesn't cover childcare, commuting, or savings. They hesitate. Days on market widen, price cuts return, and inventory normalizes from starved to merely tight. Some metros will absorb this shock through high incomes and scarce supply. Others will stall as sellers chase last spring's prices. In the countdown ahead, we'll separate resilience from wishful thinking and show where patience converts into real leverage. Here's how we define drying up, and it's numbers, not vibes. We track a 3 to 6 month stack, days on market rising, active inventory building, a larger share of listings with price cuts, pending sales slipping, absorption rate falling, and median sale price growth flattening or turning negative. Then we clean the data, adjust for seasonality, holiday slowdowns, and mixed shifts like temporary luxury surges that can skew medians. If a market only wobbles for a week, it doesn't make the list. What does? Sustained deceleration across multiple indicators, the kind you can verify and use to negotiate from strength today, smartly. At number 10, Bellingham's charm is colliding with math. The university, bay views, and trailheads still draw people north, but affordability ceilings are visible on every in-town resale. Older craftsmen and mid-century homes look entry-level until the renovation premiums show up. Roof, wiring, windows, insulation. Inventory has nudged higher, and sellers who priced to last spring now meet quieter weekends and a rising share of price cuts. Watch 3 tells here: days on market creeping past 30, inspection credits returning, and buyers asking for permanent rate buydowns before they even discuss price. Number 9, Olympia Lacey Tumwater feels stable until you run the monthly. The government anchor supports jobs, yet starter tiers have thinned, and the HOA, insurance, and tax stack lifts payments beyond what many first-timers expected. Pendings are softest in neighborhoods with higher dues or aging roofs. You'll notice more contingencies, fewer waived inspections, and sellers offering concessions early to keep deals alive. If you're buying, underwrite the association's reserves and recent assessments. If you're selling, price to today's comps or plan for credits. Waiting rarely beats math. At 8, Spokane and Spokane Valley reflect a post-migration cool-down. The mid-tier that roared in 2021 now sits longer as investors step back and true costs surface. Repairs flagged by lenders and insurance quotes on older systems push fence sitters to pause. Open houses are quieter, second weekends matter, and a good house still sells while average listings negotiate. Track the share of reductions, fall through pendings, and relists. When those stack, leverage shifts to patient buyers. If this is the opening act, imagine what the next cities reveal next. At 7, Everett shows what happens when industrial cycles collide with higher rates. Boeing's ups and downs have always shaped the local mood, but now even steady jobs can't offset heavier monthlies. Condos and townhomes that once promised affordable entry feel less so when HOA dues and insurance escalate. Listings cycle on and off, relists are more visible, and concessions are reappearing as standard practice. Closing credits, appliance packages, even prepaid dues. The message is clear. Buyers hold more leverage here than they did a year ago, and patient ones can use it. At 6, Vancouver reflects the cooling ripple from Portland. For years, it was the value play across the river, but now inventory in family-sized homes is normalizing, and sellers who expected bidding wars are trimming expectations. Buyers are pressing harder, asking for permanent rate buydowns, closing credits, and inspection repairs up front. The affordability narrative hasn't vanished, but the urgency has. If you're entering this market, don't overpay on day one. Test the seller's motivation and structure the deal with protection baked in. At 5, Tacoma's multi-year surge is flattening. Price appreciation has stalled, and older pre-war stock sits longer as buyers balk at the system's upgrades lurking beneath the surface. Inspection leverage has returned. Buyers no longer skip due diligence. Days on market stretch, reductions tick upward, and the divide between turnkey and tired grows wider. The lesson? Don't chase yesterday's hype. In Tacoma, math now beats momentum, and those who negotiate repairs and credits have the upper hand. From here, the softness only intensifies, and the higher we climb, the clearer the patterns become. At 4, Kirkland is where Eastside prestige runs into payment fatigue. The brand still gleams, water views, boutique streets, but the monthly tells a different story. Older condos with rising dues and upcoming reserve projects are discounting deeper, while non-trophy townhomes sit through second and third weekends. Absorption slows outside the perfect listing. Smart buyers underwrite buildings, not photos. Read minutes, model dues through 2026, and compare the all-in to a newer unit 10 minutes away. In Kirkland, solvency beats sparkle every time. At 3, Bellevue's shine is real, but luxury and new build pricing collide with slower tech hiring and tighter equity. Inventory is stacking in condo tiers where HOA, insurance, and amenities push payments beyond comfort. Sellers know it. Buy-downs and credits now headline listings that once needed only a skyline shot. If you're shopping, separate brand from balance sheet. Test the seller with a permanent rate buy-down and inspection credits. The best deals pair patience with impeccable due diligence. At 2, Seattle's pockets reveal the pattern. Prime neighborhoods clear fast, yet mid-rise co-ops and condos with hefty maintenance, assessments, or parking fees are posting higher price cut shares and longer DOM. The monthly, not the map pin, is killing deals. Read building financials, verify reserves, and model assessments forward, then compare the net monthly to renting nearby. If the math strains, walk. Prestige lasts, overextension doesn't. And if Seattle sits at number 2, ask yourself, what could possibly top it? At number 1, the South King County corridor, Kent, Auburn, Federal Way. The appeal is still there. Commuter access, newer subdivisions, big box convenience. But the math says pause. All-in monthlies have climbed as taxes, insurance, and HOA dues stack on top of higher rates. Mid-tier resales linger through second and third weekends. The share of price cuts jumps, pending slip. Sellers who priced to last spring chase the market down, while the few who price to today move. If you're buying, underwrite the monthly before the map pin. Target listings past 30 days, request closing credits and a permanent rate buy-down, and keep inspection protections. The leverage window is open here. Use it, or watch someone more patient take your deal today. Here's how to turn this into advantage. Buyers, stop chasing fresh listings and hunt the 21, 30, 45-day group where carrying costs soften resolve. Ask for seller credits and a permanent rate buy-down, not just a sticker cut. Read HOA minutes and reserves, model upcoming assessments, and compare the true monthly to renting. Time offers near month end or after the second reduction with inspections intact. Sellers, price to today's comps, not last spring's memory. Pre-inspect, fix deal killers, and lead with incentives. Credit for buy-down, prepaid dues, appliance package. So the payment looks solvable. Skip the drip of microcuts. Make the right cut once and defend it with condition. Now I want your ground truth. Where are price cuts picking up? Which buildings have rising fees or thin reserves? Drop your intel in the comments and I'll cue city-specific deep dives. Your zip could be next or recovering first. We'll prioritize the most requested markets next.